In the New York session, there are a lot of good trading opportunities for swinging a trade. So in this video, I'm going to talk about how to swing the trend. Not all the setups will lead to swinging opportunities. So mainly for New York Open strategy, there are two setups. The first one is the breakout upon open. So basically right after 9:30, the volume increases that give you the direction for the whole day. So if that's the case, there will be a swinging opportunity for you. Second, the economic event breakout. So for this setup, it's mainly at 8:30 rather than later of the day. We know that US interest rate decision making is normally in the afternoon, but that doesn't count because it's already in the afternoon. There could be trading opportunities for swinging a trade, but we mainly talk about the 8:30 here. When we talk about the swinging trades, one of the hot topic is when to exit and how to exit. So basically there are four types of exits here. The first one is the very classic one that we use the previous pullback. For example, we have an uptrend, so we put our stop at the bottom of the previous pullback. Whenever the trend goes down to take that stop, then we exit. Second is the previous same direction bar. The trend won't go on forever, so normally it goes to the third or fourth legs and then it could stop there. So that's why using the same direction bar in the leg, whenever it reverses the same direction bar, then we can get out. You can maximize your profit even better than the previous pullback. The third is the measured move, because for the swing opportunities here, the setup is mostly the breakout. So for breakout, measured move works well. So that's why we measure the first leg and then measure down. We are expecting the second and third leg to go to the same distance. However, for the fourth or fifth or even later on, it may not work well. The fourth approach is the scalp. So basically, like I mentioned, the waves won't go on forever. So the third leg or even the fourth, fifth leg, the market strength will be lowered. So that's why if we scalp out rather than swing out, we could have a better position for profit. Before I show you the real examples, let's get to the fundamental and see some basic about the trending. The first thing is that we need to understand the market. It always goes by trend, range, trend, and a range. So that's why to tell when the trend ends, so we're expecting something like a range behavior. This is very important. Another basic concept is how to define the trend, uptrend or downtrend. So basically for the uptrend, if the market continues to make a higher high and higher lows, then it's an uptrend. And then if the market makes lower high and lower low, that means it's downtrend. Though the concept is very basic, but it's very important when we are doing the trading. Take this chart for example. After 9:30, we can see it is a breakout. So we're waiting for the pullback and then enter the market. Here's the pullback and then here's the signal bar. So you enter the market when this bar finishes. Because this setup will lead normally to a good trending, so you want to swing your trade. So in the very beginning, you need to put your stop at the top of this pullback, which is also your exit, which is the first approach for the exit types. As the market develops into the second leg, and then pulls back, and then go down, so you put your exit at the top of the second pullback. And then the same thing, when the market pulls back again, and then go down for the fourth leg, you immediately move your exit to the top of the third pullback here. And then later on, you can exit the market whenever it hits this exit. There are two things you may notice. First thing is that it seems that market didn't even really reach the exit here. So if that's the case, when are you going to exit? That's the question, because we are trading the New York Open here. So the market will close at 4 p.m. in the afternoon. In case the market never hits the exit, when do you want to exit? So that's the first question. And then the second question is that you can see this level here. This level is very high comparing to the fourth leg here. Why can we take some profit down there or even here rather than here? It seems that we do not take much profit comparing to the entry level here. So these two issues or questions you need to think about. Now let's take a look at the second type of exit. So basically you exit at the when the same direction bar is taken off. So for example, this is the third leg here, and then all the bear bars are the same direction. So whenever a bear bar is taken off, then that's your exit. So basically you can see that this bear bar here is huge, and then the next bull bar takes out this bear bar. So basically this is your exit, and then your profit is at the top of this bear bar. So if you're waiting for the fourth leg here, and then the same thing, we have the bear bar here, and then this bear bar, you can see that next bull bar takes it off. So the exit will be at the top of this bear bar. So one thing you notice for sure is that either of the exit with the second approach here or even here is much better than the swing exit here. The third type of exit is the measure move. We measure for the first leg from the top of the bear bar, first bear bar, and then to the bottom of the last bear bar or the longest bear bar here. This is the distance we're expecting the market to go down for the second and the third leg. The same thing, we measure from the top of the pullback here, the same distance. So this is the exit if we trade only for the second leg. But for the swing, we do not exit here. Instead, at least we want to trade for the third leg, measure from the top of the pullback and then down here. So basically, if you trade this method, you're gonna exit with this bear bar here. Do we do the measured move for the fourth or fifth leg? Normally not, because when the market goes to the fourth and fifth leg, first, it may not come. Second, the market strength will be reduced greatly, so the measure move won't work anymore. So basically, the third leg for the measure move works the best. The same thing you can notice is the measure move exit here is much better than the swing exit here. The fourth type is to the scalp. So normally we'll scalp for the third leg. So when we have the second pullback here and the market goes down, we just treat it like we are scalping here. So this bar is the signal bar, and then entry is at the bottom of this signal bar, and then measure up to the pullback top here. This is the risk, and then we measure one time of the risk down. So this is the exit for the scalp. Again, normally we do the scalp exit on the third leg rather than the fourth and fifth, even though for this example maybe you can take profit in the fourth leg, but mainly just on the third one. And then another thing you notice is that this exit level is much better than the exit level if you're swinging, which is here. By the example, you can see that using different types of exit, you can get different profit. Another way that you want to see this chart is that instead of swinging the whole position to the end of the trend, how about you use multiple positions throughout the market developing and exit at different point of time to maximize your profit. That's a very good strategy, and let me show you an example. Assume I have 4 contracts of NQ, and then my strategy is that for the second leg here, it's a high probability setup, so I want to take 2 positions off. So when you enter the market, this is your risk to the top of the pullback, and then you measure down by 2 times, and then you take 2 contracts out of the market. That means you already make profits here. The reason to take 2 contracts off or partially exit the market is because you never know the market will come back and then hit your break even or even go up, reverse. So to make sure that you have something in your pocket, this strategy works well. And then as the market goes for the third leg, you do the same thing to treat this as the entry for the third leg and then measure to the top. So this is the risk. But this time we measure only 1 time down because we're not expecting the market to go on forever. So this could be your next exit, but you exit only another contract. And then for the remaining 1 contract, you let it swing, so which may exit at the top of here, or if you're using the reversal of the same direction bar, then you could exit here. How many positions you want to exit throughout the trading? It depends really on your own strategy and your portfolio setup. So basically, if this is your strategy, you take partially of the profit and then swing the last one. But for the last one, don't swing too much, because when the market goes back, it could eat up a lot of your profit. Let's take a look at another chart and then put all the exit types into one chart and have a comparison. So basically, when the market goes down here, you want to put your exit at the top of here. But when you see this too big bull bar here, and then it goes down, you may think, I want to put my exit here to protect my profit. Next approach is the same direction bar is taken off. So basically, the third leg here, so you can see this bear bar is taken off by this bull bar. So the exit is at the top of this bear bar here. For the measured move, we measure for the first leg here and then go down. So here will be your exit for the measured move. If you scalp exit for the third leg, so basically you can measure the risk here, top of the pullback, and then entry level here, measure down, you can see this is your exit. Then for these 4 lines here, they're representing 4 types of exit. So you want to choose the best one that works for you. In reality, market not always go by your expectation. So here's a very good example. The market has a downtrend here and then it developed into a trading range here. You can see the market chart doesn't look very good. So how to take the opportunity for swing trading here? Let's just take the measure move here. First leg, and then you measure down from the top of the pullback, you can exit here. Or if you use the same direction bar reversal, your exit is at the top of the this bear bar here. So if you swing exit and then you take this as the pullback, you can exit at the same level here. So this is much higher than these 2 exit. Or if you wait until the market goes up and goes down again and then use this as the swing pullback, still it is very high. As I mentioned, market always go by trend, range, trend, and range. Is there a way before the market ends you can detect the sign for trading range start, so exit in a better position? Yes. Then you need to figure out the behavior of the trading range and then identify accordingly. Here's another example. So basically there's a breakout strategy set up here and then goes down the second leg and then the third leg. So by looking back, we can see yes, this is an upward trending, but in reality when you are doing the trading, you could end up losing something. So let me show you. First, when the market goes up, breakout, and then pull back, this could be a very good signal bar. So if that's the case, the next bar pairs your entry, you're in a position. But the market didn't go up straightly, it pulls back, and then there's another good signal bar. If you choose add up your position, or even you enter here, you're in the market with the next bar. However, it pulls back again. That's the thing. So normally when the market pulls back for 3 pushes, that means there's a low probability the market will go to the same direction again. So when you see this big bear bar developing, do you want to exit manually or you're holding your position? If you're holding your position, your stop should be at the bottom of this start of the trend or even in the middle. But I think if it is in the middle halfway here, like I mentioned in my previous video, you could get hit here somewhere. So you could end up with a loss if you do not manage your trade well. And then the thing is that after you see the 4th pushback and then there's another very good signal bar, are you able to enter upon finishing this bar? Is the setup still satisfy your strategy like the New York Open breakout setup? Let's assume that you survived the pullback, so you enter at the first bull bar here. This is your entry level. You can see the market goes up and then test it here, and then goes up and then go back test it again. So if the market goes up for the second leg and then you didn't take any of your profit, and then when it goes down to test your entry level, will you be putting your stop loss order at the entry level here to ensure that you at least break even, or you keep your stop at the bottom of here, and then when you see the market goes down, you could end up with a losing trade because previously it's going up, you didn't take your profit, then you will regret you're not taking the profit. Even if you add your position and enter with this bull bar here, you can see the market almost hit the entry level. This is the right market behavior. Market always go back to test your entry level or test your stop to drive those individual traders out, and then the market takes off. Let's say when the market goes up, you already move your stop at the bottom of each of the small pullback. So basically you can see that you're gonna exit with this bull bar bottom here. This is your exit level because the market goes down to hit it. And then you can see that this swing level exit here is just a little bit above your entry level. You're not making much profit. Here comes the question. If you have multiple positions, do you want to take partial profit here with the second leg here? If you are, and then you at least have some profit, and when the market goes down to test your break even, the rest of the contract just break even. At least you make some profit for the day. If not, are you able to survive this big pullback here? Even though the market goes with the 3 consecutive bull bars breaking out, but when you see this pullback consolidation, you should realize that the market strength is reduced. So you're not expecting the market goes up too much, even though in this case it goes up a lot. But in general, you should be expecting the market can have a very big pullback like this pullback here. Let's have a look at another example of the event-driven trading opportunities. This is an economic event at 8:30, and you can see the trending is very good here. Let's just put down the exit from different types. If we do a measured move here, we can see the exit for the third leg is here. So your exit here. And then if we are using the scalp for the third leg here, your exit is here, a little bit lower than the measured move. If we swing and then the small waves here, and then basically your exit will be here. This is your pullback, and then this bear bar pierces this pullback. So this is a swing exit. And then last, if you're using the reversal of the same trend bar, okay, so here this bull bar is basically reversed by this bear bar. So you can see that here, 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 and here, there are 4 levels.